Tonight's video is not going to be very structured. I just wanted to share a few things with you. As I keep my finger on the pulse of the property market, my current and um, opinion that I've held for a little while now is that if you're looking to buy property, again, not financial advice, but this is what I would do, and it's probably something that I'm thinking about, is that if you're looking to buy to live in, you can start looking, get the feel for the market, see what area you like, see what the auctions are going for, whether you can afford it, so you can settle for the area when it eventually pulls back a bit more. If you're looking to invest, I wouldn't invest in property for a long time because it's at best going to go sideways. Now, having said that, there's an anecdote by one of the colleagues or one of the guys I work in the same office with, and we had a quick chat. He's looking for a house around, let's call it Epping in New South Wales. So I had a look there, and he gave me an interesting insight. So this is one of the ones that I was looking at. It's in Epping. It is 4 bedroom, 2 bath, 2 parking. It's got a 1,000 square meter block, but when you see that it's a nice house, although you have to admit that every time you look at any houses for sale, they look so much better on the photos because they're professionally taken photos, and they also kind of widened and deepened. So the space, pretty much the end effect is that it looks bigger. It definitely looks bigger. It's always like that. But anyway, it looks like a nice big house with a swimming pool. And a lot of these around national parks will have a lot of bush. They'll be hilly, and that's kind of a problem with them. They're nice. You're buying yourself a bush, but there's not much you can do with it. There's like a residence there. There's a pool that we saw there, and this is the driveway. And then you got this, which is pure bush. There's not very much you can do with it. Like if you wanted to build a granny flat or anything, it will be down the hill, really like national park type thing. Now I'm talking about this because of the colleague at work looking at it. So this one's 1.4 million to 1.48 expected. This is a very good segue. He didn't tell me about what house he was kind of bidding for or giving offers for. But so, given that Sydney's average price is about a million, I think. Now, it's questionable what they call Sydney. Is Blue Mountains or beginnings of foot of the Blue Mountains? Is it, for example, Sydney, and then you got Central Coast, and you go very far away places southwest, like towards Camden. And I don't know if that's Sydney, and that some of those places may be bringing the average price down. But if a million is an average, and this is kind of a above average and above suburb, so it's definitely a bit better than the average in your Sydney market. So, but what I was looking at also, we'll get back to my friend's story. What I was looking at, see, it's creek. It's got so that's the property, and it's backing into the creek, which means that you got a steep hill down with all the bush there. You can't touch any of it. You think you buy a piece of land with a house on it, and you think you can do anything reasonable to it. Maybe you can, but you'd probably have to apply for many permits and licenses from the council to cut like a tree and a little bush to build yourself maybe a granny flat. So, but what caught my attention is that this is a good example. If this house was to go to for $1.4 million and you had 20% deposit, which is sizable amount of money, $280,000 on 30-year loan term, principal and interest will cost you at today's very low interest rates, which looks like they're going even lower. It's going to cost you $5,168 a month. That's a bit. It could be worse, but let's not forget, these are historically the lowest interest rates ever. But again, what caught my attention is this graph. This is the suburb report. So what it's looking at is, so it's the It's looking at the similar houses in the same area. By the way, this website, if you haven't recognized it by now, it's domain.com.au. I prefer to look at it over the realestate.com.au. So what's interesting, in 2015, the median price was just under 1.5, so 1.495 million, and then 2016 went up to 1.6 million as the median or average price. I know someone will end up commenting saying median and average price is not the same thing, but let's just say, this is around the price that you had to pay. In 2017, 1.8. 2018, it kind of still edged up a little bit, although 2017 was supposed to be the peak, maybe not in this suburb for this type of house, but yeah, so it went up 1.833 million dollars, and then bam, now this is we're in July 2019, so 24th of July, so a little bit over halfway through 2019, and it's gone back down even below the 2015 prices. And if we know that, once you buy a property, unless, if you were to sell it after that for exactly the same price because of all the transactional costs, including stamp duty, legal costs, surveying, and pest controls, and all of those things, you're probably looking at another, 5 or 6% that you are down if you sell it for exactly the same price. You are under water by up to about maybe 6%. So, and this is now lower than what it was 2015. The data doesn't show, but you probably have to go a few more years back. So what this shows is that anyone who's bought, 2014 and after in this area, this sort of house is underwater. But having said that, a friend of mine, he's looking, cut long story short, for his child to be in this catchment area. So they've zoned the area where he lives. So he wants to buy around Epping. And he said that the prices have actually edged up a little bit. And it's something that was $1.4 million is now selling for 1.6. So he gave an offer, not for this house, but somewhere around the same area. The guide was about similar as 1.4 to 1.4 or 1.5. So he gave about 1.4 $450,000. So somewhere toward the upper end of it, and the vendor decided to go at the auction anyway, and he got sold for 1.6 million. And so because my colleague has been looking, he had noticed that in the last few months in these areas, the demand's gone up, and on average for a house that's about $1.4 million, now they're selling for 1.6. So the prices have gone up, and as many channels and people point out, it's not one market. Some suburbs will do much better, and parts of, say, Australia will do much better than others, and some will just stagnate and go sideways, seemingly what seems like forever. So that's very interesting, but not financial advice. My opinion here, educated opinion, is that this is a bit of a sugar hit that Scott Morrison government is in. There's no quote unquote crazy labor policies that would kill the economy and the property market are not going to eventuate. So there's a bit of a sugar hit. People have got the confidence back. The Reserve Bank of Australia is saying we are going to cut interest rates even lower. But what I think is going to happen exactly that is that it's going to fizzle out by about January. And once we hit January and those new benefits for the first home buyers that the government is giving to make up for the 20% deposit will turn out to be not helpful, and that's when people will start losing confidence and realizing that this is really not a turnaround, but what they call, and there's a lot of comments, and I appreciate it in the comment section of every one of my videos, and I absolutely totally agree, is a dead cat bounce. What is a dead cat bounce? Here's a real life example. He's a Irish and UK house prices. We're probably best concentrating on Irish house prices, which is the blue chart, and starts from January 2006 here. So the peak was about, again, don't quote me on it, but 2006 month 9, so September. So it comes down, and then if you're at this spot and it starts coming back up, you don't have the benefit of the hindsight. So you didn't really know that this was going to go down that sharply. You would have, what they're saying now is that we're bottoming out. So you can call this we're bottoming out. This is what they're calling here as a bottoming out, because it's gone back up a little bit because of this sugar hit. And in my opinion, so everybody is expecting it to end up keep going up, because it's just one of those little bumps in the road. But no, it wasn't to be. So it kept going down after a little, come back up, and then this would probably, I'm pretty sure, would have been reported as a positive number in a month or a quarter, and then it just kept going down. So that's your kind of typical example of that cat bounce, where it's a bull trap. So it as it's looking that it's going to turn around and keep going back up, so it's a bull trap. It isn't a new start of a new bull trend yet. It's just a continuation of or the beginning and the continuation of the downtrend. That brings us to my next point. This is the chart that Martin North has had on his last live stream, which I watched afterwards, and I hope he doesn't mind. And I strongly recommend and urge you to go and check out Digital Finance Analytics YouTube channel and subscribe to it if you're not already. I'd be surprised if you're not, given that you're watching my channel. But without giving out too much information, this was the chart, and Martin now with his, I think, 52,000 strong survey results of households and around the country. He boils it down to what his scenarios are, famous scenarios. I really like him. That's the best thing I've ever seen. And he's now given the biggest probability of 30%. Yet there's other scenarios that are given 25. But let's say the top possibility scenario at the moment is what he calls Armageddon Island 2.0. We did talk about the island situation where the unemployment rate shoots above 8.75%. RBA cuts interest rates down to 0.25% because they're panicking. There's 12 plus bank losses, basis points. Not sure what this means. What is more important, however, is that in this scenario, the houses and housing continue to drop further 30 to 45%. I don't know if it's further 30 to 45% or 30 to 45% all up. And there's a bail-in, bail-out, and quantitative easing 2.0. So again, 30%. So for the full information and all the numbers, and to stay up to speed as to what these outcomes and scenarios are as they keep changing given the changes in the domestic and the global economy, go to Digital Finance Analytics on YouTube. And last but not least, my last video was They Want to Fail, RBA Deception Behind the Sharp Interest Rate Cuts, where I describe my opinion why they're cutting the interest rates, pretty much summed up with one of the viewers' comments where Tobacco says, good point, the RBA is trying to save the property market and is using the unemployment rate as an excuse. But we won't go into that. You can watch that video. It's my last video before this one. The good comment that I want to read out to you also is from Ron Broomhall. Says, nothing will save this upcoming property crash. 35 to 50% falls from their peak 2017 peak over the next 12 to 36 months. Real estate is so overvalued compared to average wage, and the market will only correct itself. Sure, a lot of us believe in that. Let's just not make it an echo chamber. Let's do our own research. Mine has concluded that to be correct. And then Wing Ki Chan replies back, bottom out in 36 months, as many claim. Try 130 months. Look at Tokyo Price Index and how that market bottomed off with 2 decades of low interest rates and multiple QEs. Their bubble burst in 1991 while population was still growing to peak in 2010. Very good point. And that was always my point. If you had such a bubble in any asset class like we did in Australian housing in the last few decades, and we expect it to pull back by about 15%, say, and call it a bottom is just impossible. Every bubble retracts back by at least 40 or more percent. So this would be I think the first bubble ever that just didn't do that. But the Wing Ki Chen sends us to a link that has a staggering chart that shows that can get bounced. This is about 87 from what I can see here, 86, 87. This is the peak. And imagine being here and it comes down here, and then and then it comes back up, and everyone thinks, oh yeah, we've all seen charts, right? We think this is it, it's fallen back enough, and then it keeps going back down, and everyone thinks, well, this is definitely it when it turns back up, and it goes up and down a bit, and you think, all right, it's coming back. Really, the trend has changed back up, yet only to in 1990 finally decide to go down, drop down, and not look back for decades and decades. So this is the Residential Property Price Index, Tokyo metropolitan area, 1984 to 2018. This is staggering. I mean, if you think that it can all correct itself in a few years once again and continue to go back up to the stratosphere, think again. Really, I mean, we would be the first and ever the only probably major bubble that has done that. So I continue not to think and believe that that's going to happen. So thank you, viewers. Without you, I wouldn't have seen that link and everything else. I read all the comments. I reply to none, but please stay engaged, share your knowledge. Ron's original comment spawned 24 replies alone just in the last 3 days. So let's talk again soon. Take care.